Hello and welcome to the latest Insider interview. Our guest today is Luke Finch of HgCapital, the private equity group which manages HgCapital Trust. Luke, thanks very much for coming in.
Morning, thanks for having me.
So you invest in a basket of high quality business-to-business software companies. Are you paying a premium for these types of stocks? And is there a comparison we can make to big benchmarks, perhaps the S&P 500, in terms of valuations that you're paying?
Well, a premium to what? I think for comparable businesses listed in the US, we probably pay in line with what you'd need to pay to take those private. So Intuit or Microsoft with a 20 to 30% premium would be sort of equivalent-ish valuation to some of the things we've bought recently. I mean, ultimately, when we drill down to it, and how we think is we buy cash flows, we buy growing cash flows, and EBITDA is an approximation to cash flow, but it's not actually that consistent sort of across different industries because depreciation is very different in different industries. So in software, we don't really have any asset depreciation. So our EBITDA is very close to cash flow. What it means is typically we're buying businesses at sort of 20 to 25 times forward cash flow. And if you sort of look at other places you could buy cash flow growing strongly, I don't think we're paying a premium.
And you're just investing in profitable companies then?
Yes, 90% of our portfolio is highly profitable. We sometimes buy businesses that are on the journey to profitability, but where we can see that the kind of core customers, old customers who've been buying the product for longer are highly profitable. The typical margin across our portfolio is mid 30% EBITDA margin and similar on a cash flow basis.
So really high profit margins. What about that profit growth and revenue growth? What are you typically seeing there in your portfolio?
Yes, I mean, if we look at HGT's portfolio and the top 20 is a proxy for our whole portfolio, it's growing kind of revenues at nearly 30% last 12 months and profits at nearly 30% as well. About half of that is organic growth, and the other half is M&A. So M&A is a big part of our strategy across a lot of our businesses. So that's buying smaller companies, buying products to sell to your existing customers. It's a big value creation driver for us, and it adds a lot of value and innovation for the customers of our companies as well.
HgCapital Trust is part of HG, the private equity firm. Do you normally take over companies completely? Do you take full ownership of companies? And when you own stocks, what do you do? Do you help them become better businesses?
So we try and take a majority, not necessarily the whole thing. Management or founders are often big investors alongside us. If we look at two of our biggest businesses, Access and Visma, sort of management and own between sort of 10 and 30% plus of those businesses, and that's pretty widely distributed. So that might be 200, 300, 400 people in that shareholding across the business. We think that's a really powerful driver of engagement and returns and alignment. But where we can, we will take control. And then we'll support those businesses with a long-term view. I think one of the really powerful things about private equity is aligning long-term capital. So we think in 5-year horizons, with management owning chunks of their businesses, with options to own more if they perform, and with a clear plan over that 5 years. And so businesses are thinking, how do we improve ourselves? Maybe that means investment over the next few years. So margins might be depressed, but will grow stronger in years 3, 4, 5. And they're not thinking kind of quarter by quarter. How do I manage for my shareholders on a quarterly basis? And I think that's one of the most powerful sort of fundamental differences in private ownership versus public ownership. And then when we own our businesses, there's 50 of them in the portfolio roughly. They can all learn from one another. We can learn from them. We can take best practice and help the portfolio learn about that. We have a team of nearly 65 operators working at HG who have, run the European sales team of Microsoft or run cybersecurity at a large cybersecurity listed business. These people have run kind of big divisions in big software companies, and they go in and they help our companies, make change faster.
Can you give some examples of when HG has gone in and actually created a lot of value for your companies?
Yes, well, let's take Visma as an example. We first invested in Visma way back in 2006. We actually delisted it from the Oslo Stock Exchange, and we were a white knight, so we were invited in by the board because they were under a hostile public offer from Sage PLC in the UK. And Visma at the time was about 400 million euros of market cap, enterprise value. Sage was, 5 or 6 billion at the time. Fast forward to today, we've continued to back Visma with supportive capital, thinking in those 5-year cycles, but we're coming up to our 4th 5-year cycle with them. And the trust has been invested all the way through, and Visma's now 16, 17 billion euros of enterprise value, and Sage, I haven't checked recently, but probably still somewhere in the 5 to 10 range. So what we've done with Visma is we've helped them with M&A. They've expanded out of Norway, across the Nordics, now into the Netherlands. They've innovated in product. They've been through a SaaS transition. So I spoke earlier about sort of the old license revenue model, moving to SaaS, unlocking a lot of value. Visma is now the largest SaaS business in Europe by revenue. And that's because the management team take a lot of, almost all of the credit there. We've helped them along the way, and we've been very supportive, and we've given them that time. Changing your product to SaaS is a huge investment. It's 50 million euros of R&D, and you don't get it right first time. So you probably have to spend more and do it for longer. But taking it off the glare of the public markets has allowed Visma to do that. And now, as it's getting bigger and bigger, it's actually posting its best ever organic growth as it scales.
So you're investing in business-to-business software. Are there any areas within that sector which are particularly exciting at the moment and you've made some big acquisitions in?
Well, our definition of exciting is maybe different to a lot of other people's definition of exciting. So our definition of exciting is things that grow, 8 to 12% organically, but very, very consistently, where you have 90 to 100% of your customers renewing every year, where you can add more and you sort of roll up, you snowball up, you compound up. We get very excited by that. We don't get excited by things growing 100% a year in an infinite market that are going to change the world. Other people get excited by that, but we find that kind of very hard to judge and to make calls on. So where we find our kind of excitement, the boring excitement, is tax software, accounting software, bookkeeping software, payroll software, compliance software, insurance software, operating systems for healthcare, the sort of unglamorous stuff that's helping, frankly, expensive professionals be better at their job, comply better with regulations, understand their customer better, manage their data better. That's what gets us excited. So we're not the most exciting dinner party guests, I'm afraid, from HG.
And this is a private stock portfolio. You update the net asset value of the fund every 3 months. That's kept ticking higher this year, even as public markets have fallen, and particularly software companies have fallen this year. So what's that process, and why is it resilient when public comparisons are struggling at the moment?
Yeah, so we value every individual company in our portfolio kind of bottom up, line by line, and then the trust gets a valuation that reflects its ownership of each of those businesses. But there's a number of components that go into valuation for us. One is earnings growth. The second is then comparable listed businesses and comparable transactions over the last few years for those businesses. And then the third is exits we have above book value. So if we sort of unpick that, the comparables for our portfolio have come down, and we've taken our comparables down with that. So you've probably seen a sort of 10 to 15% fall in our valuations from that effect. They haven't swung as wildly as some of the high growth VC or really high growth tech stocks. They didn't sort of march so far up the hill, and we haven't had to bring them so far back down, but they have come down. But then that's been offset by earnings growth. I said earlier that we had nearly 30% EBITDA growth over the last 12 months. And then we've had a number of exits above book value. So we've realized 4 or 5 investments this year, on average at close to a 30% uplift to the December book value, if you take December as maybe a high watermark in the public market. So people see the value of our businesses. They're willing to pay for the value of those businesses. And I think one of the things I often say to our investors is, a lot of the uplift we get on exit is quite structural, because the rules tell us to value our businesses off trailing earnings, LTM earnings, which we do. But because of the types of businesses we back with highly recurring revenue, often contracted, recurring revenue, we're almost always able to sell our businesses off a 12-month forward earnings number. People will buy off next year's earnings because they can see at the start of every year 90, 100% of that, in the bank, in the can. And if your businesses are growing at 30% and you switch from a historic earnings number when you sell to a forward earnings number, you get a pop on value. And so that that 30% uplift we had in 2022 exits is very similar to our 20-year average. I think it's about 25, 26% uplift over 20 years and hundreds of exits.
But nevertheless, it's on about 20% discount. So investors are telling you that actually we think the real value is below what HG is.
Well, the marginal seller of HGT is saying they're prepared to sell at that value. The buyers of our companies are telling us they're prepared to buy at 30% uplifts. So who's right?
So that could be,
I think there's an opportunity
there.
I think so, yeah.
And has the board been buying back shares? Has it seen that opportunity?
They did their first ever buyback in Q3. I mean, it was very small. I think it was only £1 million or so worth out of a 1.8 billion market cap. But it moved the price that day. It showed confidence. I mean, ultimately, we don't really want to be buying back shares because this is a long-term compounding vehicle. But yes, I mean, I think the board believe that a discount that wide is wrong.
How do higher interest rates affect the private equity industry? This could be relating to companies and valuations, but also raising money.
Yeah. I mean, if we sort of take companies first, and our companies in particular, higher interest rates obviously affect your cost of funding. Typically in our capital structures for our companies, it's sort of 60 to 70% equity anyway, and only 30% debt. So it's not a big component of what we do. But then if you can pass on kind of inflation or rates, to your customers because the product you deliver has value and they themselves need that, then net a raising rate environment is good for our portfolio. And I guess if as I said earlier, if the products we sell to through our portfolio to their customers are about making businesses more efficient and helping them reduce costs, then I think a kind of rising cost environment is actually a driver for more and more software adoption, and we're seeing that. As regards the whole industry for private equity, look, I think private equity's been going for 30, 40 years. It's I remember not so long ago having kind of 6% as my cost of capital in all the models when I was an investment banker, sort of 15, 20 years ago, and people were still able to make good investments then. I think it's actually the last few years have been an aberration, and I think having a more normal cost of money is, I think, good for the industry.
Finally, the question we ask all of our guests: do you personally invest in the trust?
So I do. I mean, all the executives at HG personally invest in our funds directly, so that's where the bulk of my investment's gone. But obviously, I'm able to invest in the trust very rarely when it's open, and but through tax efficient wrappers. So I have my kids' ISAs in there, my wife's pension in there, my ISAs in there. So anything I can put in a wrapper, I'll put in the trust. Anything I can't, I put directly into our funds.
Luke, thank you very much for coming into the studio.
Pleasure.
And that's all we've got time for today. You can check out more insider interviews on our YouTube channel. Don't forget to like, comment, and subscribe. See you next time.